Want to turn your savings into a wealth-building machine, but scared to take the first step? Discover how to conquer your fear of investing and start growing your money even if you're a complete beginner. How to overcome the fear of investing and start growing your money. Introduction. Investing is one of the most effective ways to grow your wealth over time. However, for many people, the idea of investing can be intimidating, even frightening. The fear of losing money, the complexity of financial markets, and the overwhelming amount of information available can paralyze potential investors, preventing them from taking the first step toward financial growth. This note aims to demystify the process of investing, address common fears, and provide practical strategies to help you overcome these fears and start growing your money. Understanding the fear of investing. 1. Fear of losing money. Root cause. The most common fear associated with investing is the fear of losing money. This fear is often rooted in a lack of understanding of how investments work, as well as stories of people who have lost significant amounts of money in the stock market. Reality check. While it's true that all investments carry some level of risk, the key is to understand that risk can be managed. Diversification, proper research, and a long-term perspective can significantly reduce the likelihood of losing money. 2. Fear of the unknown. Root cause. Many people are afraid of investing because they don't understand how financial markets work. The jargon, the complexity, and the sheer volume of information can be overwhelming. Reality check. Investing doesn't have to be complicated. With a basic understanding of key concepts like stocks, bonds, mutual funds, and ETFs, anyone can start investing. There are also numerous resources available, including books, online courses, and financial advisors, to help you get started. 3. Fear of making mistakes. Root cause. The fear of making a wrong decision can be paralyzing. People often worry that they will invest in the wrong asset, at the wrong time, or in the wrong amount. Reality check. Everyone makes mistakes, especially when they are new to investing. The important thing is to learn from those mistakes and not let them deter you from continuing to invest. Over time, you will become more confident and knowledgeable. 4. Fear of market volatility. Root cause. The stock market is known for its ups and downs, and this volatility can be frightening for new investors. The fear of a market crash or a sudden drop in the value of investments can prevent people from investing altogether. Reality check. Market volatility is a normal part of investing. Historically, the stock market has always recovered from downturns and gone on to reach new highs. A long-term investment strategy can help you ride out the ups and downs of the market. Strategies to overcome the fear of investing. 1. Educate yourself. Knowledge is power. The more you know about investing, the less intimidating it will seem. Start by reading books, attending seminars, or taking online courses on investing. Understanding the basics of how different types of investments work will help you make informed decisions. Stay informed, keep up with financial news and trends, but don't let short-term market movements dictate your investment strategy. Focus on long-term trends and the fundamentals of the investments you are considering. 2. Start small. Dip your toes in. You don't need a large amount of money to start investing. Many online brokers allow you to start with as little as $100. Starting small can help you get comfortable with the process without risking a significant amount of money. Use micro-investing apps. There are several apps available that allow you to invest small amounts of money in a diversified portfolio. These apps are a great way to start investing without feeling overwhelmed. 3. Diversify your investments. Spread the risk. Diversification is one of the most effective ways to reduce risk in your investment portfolio. By spreading your investments across different asset classes, stocks, bonds, real estate, etc., you can reduce the impact of a poor-performing investment on your overall portfolio. Consider index funds and ETFs. Index funds and exchange-traded funds ETFs are a great way to achieve diversification with minimal effort. These funds track a specific index, such as the S&P 500, and provide exposure to a wide range of companies. 4. Adopt a long-term perspective. Think long-term. Investing is not a get-rich-quick scheme. It's a long-term strategy for building wealth. By focusing on long-term goals, you can avoid the temptation to make impulsive decisions based on short-term market movements. Stay the course. It's important to stick to your investment plan, even when the market is volatile. Historically, the stock market has always recovered from downturns, and those who stay invested are more likely to achieve their financial goals. 5. Seek professional advice. Consult a financial advisor. If you're unsure about how to start investing, consider consulting a financial advisor. A professional can help you create a personalized investment plan based on your financial goals, risk tolerance, and time horizon. Robo-advisors. For those who prefer a more hands-off approach, robo-advisors are a great option. These automated platforms use algorithms to create and manage a diversified investment portfolio for you. 6. Practice emotional discipline. Avoid emotional decisions. Fear and greed are two emotions that can lead to poor investment decisions. It's important to stay disciplined and stick to your investment plan, even when the market is volatile. Stay calm during market downturns. Market downturns are a normal part of investing. Instead of panicking and selling your investments, use these opportunities to buy quality assets at a discount. 7. Set clear financial goals. Define your objectives. Before you start investing, it's important to define your financial goals. Are you investing for retirement, a down payment on a house, or your children's education? Having clear goals will help you stay focused and motivated. Create a plan. Once you have defined your goals, create a plan to achieve them. This plan should include your investment strategy, risk tolerance, and time horizon. 8. Monitor and adjust your portfolio. Regular reviews. It's important to regularly review your investment portfolio to ensure it aligns with your financial goals and risk tolerance. This doesn't mean you should constantly buy and sell investments, but rather make adjustments as needed. Rebalance your portfolio. Over time, the performance of different investments will cause your portfolio to become unbalanced. Rebalancing involves adjusting your portfolio to maintain your desired asset allocation. Common investment options for beginners. 1. Stocks. What are stocks? Stocks represent ownership in a company. When you buy a stock, you become a shareholder and are entitled to a portion of the company's profits. Pros. Stocks have the potential for high returns, especially over the long term. They also provide liquidity, meaning you can easily buy and sell them. Cons. Stocks are volatile and can be risky, especially in the short term. It's important to research and choose stocks carefully. 2. Bonds. What are bonds? Bonds are debt securities issued by governments or corporations. When you buy a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal at maturity. Pros. Bonds are generally less risky than stocks and provide a steady income stream. They are a good option for conservative investors. Cons. Bonds typically offer lower returns than stocks, and they are subject to interest rate risk. 3. Mutual funds. What are mutual funds? Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers. Pros. Mutual funds provide diversification and professional management. They are a good option for investors who prefer a hands-off approach. Cons. Mutual funds charge management fees, which can eat into your returns. They also require a minimum investment in some cases. 4. Exchange-traded funds ETFs. What are ETFs? ETFs are similar to mutual funds but trade on stock exchanges like individual stocks. They offer diversification and are typically more cost-effective than mutual funds. Pros. ETFs provide diversification, low costs, and flexibility. They can be bought and sold throughout the trading day. Cons. Like stocks, ETFs are subject to market volatility. It's important to research and choose ETFs carefully. 5. Real estate. What is real estate investing? Real estate investing involves purchasing property to generate income or appreciation. This can include residential, commercial, or rental properties. Pros. Real estate can provide a steady income stream and potential for appreciation. It also offers tax benefits and diversification. Cons. Real estate requires a significant upfront investment and ongoing maintenance. It is also less liquid than other investments. 6. Retirement accounts. What are retirement accounts? Retirement accounts, such as 401ks and IRAs, are tax-advantaged accounts designed to help you save for retirement. They offer various investment options, including stocks, bonds, and mutual funds. Pros: retirement accounts offer tax benefits and long-term growth potential. They are a great way to save for retirement while reducing your tax liability. Cons: retirement accounts have contribution limits and penalties for early withdrawals. It's important to understand the rules and restrictions before investing. Conclusion: overcoming the fear of investing is a crucial step toward achieving financial growth and security. By educating yourself, starting small, diversifying your investments, and adopting a long-term perspective, you can build a solid foundation for your financial future. Remember that investing is a journey, and it's normal to encounter challenges along the way. The key is to stay disciplined, stay informed, and stay focused on your financial goals. With time and experience, you will become more confident in your investment decisions and be well on your way to growing your money and achieving financial success.